Okay, and we've got first question, it looks like, that came in from James. James says, how can you make money buying puts, and at what delta would you use? James, that is an excellent and fair question. Of course, a very perfect question for this time in the market. Now, Sam is a regular attendee of ours here on the Friday sessions. I don't think he's in yet, but he's regularly in here. He comments from time to time, James, on using UVXY as a volatility hedge for his portfolio. I tend to use VIX calls, but I haven't been able to buy VIX calls really in the past, I don't know, 5 weeks, 4.5 weeks or so, because of the high cost on that structure. Where I'm going with this, James, is that Sam had mentioned, I didn't get a chance to historically backtest this yet, but Sam had commented that many investors, who bought puts to try to take advantage of the 2008 decline once it started, actually lost money. And the reason why is because the implied volatility on the put options was so high that when the market stabilized, even though it fell for a little bit, but when it started to stabilize before it came back up, the volatility collapsed. And they lost a huge amount of money for the volatility crush that wasn't countered by the intrinsic gain of the stock still falling. That's something that you have to be careful of in these situations. But the question is, we're talking about buying a put option, of course. Let's just go to long puts. And your question is, well, how can I make money buying puts, and what delta would you use? The true answer to that question, James, is more based on what do you think the decline will be on the securities that you're looking at. That will help you determine which option is going to give you the best bang for the buck. In general, I'll say if you're looking further out in time, if you're going 5 to 6 months, most investors I know will tend to buy a slightly in the money, maybe a delta of 0.6 to 0.8, somewhere in those lines, for a longer time frame, so that even if the market doesn't move, well, most of what they're paying it is intrinsic value. But in this market, with the extremely high implied volatility, even going 6 to 8 months out, we're going to be spending a lot for extrinsic value because of the inflated implied volatility. So, in general, I'd say that I would look for that if I was looking longer term, to buy a call anticipating a rebound in the future, or to buy a put even now. I'm not going to buy something that's 1 week out, James, or 2 weeks out. I'm going to buy something that puts more time on my side. 3 months out, 4 months out. It's going to be expensive, but I'm trying to play a longer game than short-term fluctuations with a lot of volatility, which can see a volatility collapse. I buy something for next week's expiration, which will be on Thursday, the 9th, not the 10th of Friday, because the markets will be closed. I might see a volatility crush over the weekend and a lot of time value decay out. Now I need more of a movement to the downside. Okay, all that being said, we have a great tool for you here on PowerOptions. And under long call and long put, and in the signature tools, you can click on the long option finder. It's a very simple tool, but what it allows me to do is to just put in a stock symbol, and I'll put in SPY. And let's say I feel the potential. I think we closed today at around 245, 246, somewhere in that range. It was a little bit higher, 248. But in any case, let's say I'm expecting the stock to maybe see a 10% decrease, or SPY to see a 10% decrease over the next 20 to 30 days. Okay, so we think it's going to drop another maybe $20, $24. Let's put in a price of $225. And let's just say I'm going to invest $1,000 into SPY calls. Now, I may need to increase this. That might not. In fact, I probably do. I'm going to put in $2,500. A lot of those put options are probably going to have a higher premium. Okay, let's see here. All right, so I'm going to put that in there. And the expected date, of course, let's go beginning of May 5th, May 6th, somewhere in that time frame. All right, so about 30 days out. Let me hit submit. Okay, now William commented in and said he can't see the screen. It looks like most of you are able to see the screen, and I'm able to see it as well. We're just running this submit here real quick. Okay, all right. Okay, so William, I'm sorry, William, what you may need to do is log off and then log back on if you're not seeing the screen. Hold on one moment, ladies and gentlemen. Okay, so this is great. Now, interestingly enough, as I mentioned, we're at about 248.59 current price. With the time frame I selected, James, we see here that the put that would give me the most return based on the theoretical pricing models would right now be the in the money May 8th 259 strike with a price of $17.97. I can afford to buy one contract with the 2,500. That's the volatility for you. And we'd see a return on this of about 89%. Now, they're pretty much all even in this case. And if the stock did hit my target, of 225 in this case, the estimated value to be 3,400. Well, that makes sense, isn't it? It showed us the 8th of May. I put in the 6th of May as the expiration date as well. Okay, and so that makes perfect sense. We're right at intrinsic value for all these options because it's only 2 days remaining to expiration. We would have lost all of the implied volatility on that position. This is $11 in the money, so we've got $6.90 some odd cents roughly of extrinsic value with the current volatility of 0.3717. Okay? Now, this means that all the volatility would be wiped out. All that extrinsic value, James, would be wiped out of this position. It'd be trading right at extrinsic with only 2 days to go, but all these would have roughly about the same return, about an 89% return if I felt there was a 10% potential decrease. Okay, so maybe a little bit more than 10%, but right around 10% decrease in the position. Is this to say that this is always going to be the same? Meaning that the in-the-money option here, this 259, which is only 35 days out, and at the same time, probably has that delta I mentioned of 0.6 to 0.8, is this always going to show up? Not necessarily, but in a normal expected movement of a position, of an underlying security, what I expect to see on this tool is the at the money to slightly in the money, 1 or 2 strikes in the money, always coming up as the best result. And what do I mean by a normal move? 4 or 5% move maybe in 20 to 30 days. Normal market conditions, strong or weak, 4%, 5% down. If I expected more of a move, I expected something disastrous and expected this maybe to drop all the way down to 200. I'm not saying that's my projection. I'm not saying that's what's going to happen. But if I do, we run that again. Hopefully it comes in a little bit faster this time than it did the first time. But with this type of severe move, James, what I'd expect to see on this tool is it's probably going to give me out of the money options right now that are less expensive and will have the highest potential percentage return if the stock hits our target on our target date. That's what I would, expect to see in those scenarios. So it's different based on the stock you're looking at and your projection for where it's going to fall. In general, if you don't have an if you don't have an expectation, so we start here out now with the 229 strike on the stock trading at 248, and if that severe of a move, we'll see a potential 300% return. With the out of the money option that's only $7 per contract, we could buy 3 contracts, and we'd expect the large profit if our underlying hit that severe decline within the next 30 days or so. So it'll change based on your expectations. A good rule of thumb, though, in general, is that when you're searching for long calls or long put positions, you're probably looking at to slightly in the money, probably with a delta of maybe, say, 0.55 to 0.8 or 0.55 to 0.75, somewhere in that range. But again, that tool, the long option finder, is extraordinarily powerful to help you find which option will give you the best return based on your expected movement of the stock and your expected time frame. Okay, so rules of thumb on that there with the delta buying for puts or for calls, and of course using the long option finder to narrow it down without having to go into the chain, analyze and find the deltas, then go to a Black-Scholes pricing model and calculate manually through that the expected value of each option. If the stock hit your target and your target price, the long option finder does all that heavy lifting for you. I think it'll guide you in the right direction as well. All right. James, follow-up question, and your risk is only what you put into the position or only what you paid, correct? Absolutely. But I want to be clear on something, okay? A lot of investors say that certain things such as a bull call debit spread, a long put, a long call, even a bear call credit spread or a bull put credit spread are low risk positions. They're not necessarily low risk positions. They are known risk. And if you personally don't practice proper position sizing, that could come back to hurt you. Let me take a look here real quick. This is from our default Bollinger Band screen on the long put search where we're looking for positions that are near the bottom of their lower Bollinger Band. We're going to go to the profit and loss chart. And this option at midpoint would be $1.49. If we're lucky enough to get midpoint, it's kind of a wide bid-ask spread, $1.10 to $1.88. It's got almost a 70% bid-ask spread there, percentage-wise. But in any case, let's say we get in at 149, 150, James. If the stock does the opposite and moves up and in, I'm sorry, I didn't look at our time frame here. This is the June put, so it's far out in time. But if I hold it all the way to June, make no adjustments, don't close out early, the stock's trading above our strike of 24 expiration, I will lose that full 149. Okay, that's the most I can lose. I cannot lose more than that. I paid it, even if I paid into higher implied volatility and extrinsic value, I know my risk up front, what I paid into it, exactly what you said. But is it a low risk? Well, if I only buy one or two contracts, and that total payment only represents maybe 2 to 3% of my total portfolio, I would say yes, that's low risk. If I buy 30 contracts, of course, and I invest $4,000, and this, let's say my portfolio is $45,000, so this represents 10% of my total portfolio, and the market goes the opposite direction, and I lose 100% on this put, then yes, I might say this is a little bit too much. This is not low risk. It's a known risk, but if you don't practice proper position sizing, James, then I'd say that yes, this is probably too high of a risk. You usually want to make sure that calls or puts that you buy represent only a reasonable portion of your total portfolio because remember, in the credit spread, debit spread, long call, long put, you can lose 100% of what you invest into this position. So that's why the proper position sizing is key to being successful in those strategies and really in any strategy as well.